Hello financial fans, welcome back to another stock analysis. Today we'll be covering AT&T stock ticker T. AT&T is a telecommunications company that provides a range of communication and entertainment services, including wireless and wired voice and data services, broadband internet, video and satellite TV. AT&T is one of the largest providers of mobile phone services in the United States and also provides wired internet and home phone services. The company operates AT&T TV, a streaming television service, and AT&T Fiber, a high-speed fiber optic internet service. AT&T's business also includes advertising and marketing services, as well as the provision of various businesses and government communication solutions. In recent years, AT&T has also expanded into the media and entertainment industries, acquiring companies such as DirecTV and Time Warner. The company's overall mission is to connect people with the world and each other by providing innovative and reliable communication and entertainment services. Currently, their market cap is sitting at $141.6 billion, and in 2021, their revenue was $168.9 billion. The dividend yield is currently 5.55%. 73% of their revenue is generated from the communications sector, 24% from Warner Media, and the remaining 3% from Latin America sources. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, financial health, and the growth of the company. We'll be using a standard margin of safety of 25% that can either increase or decrease by the ratios that we're going to look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in that scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and 10% or bright green will mean a 10% deduction. When we're using 3 colors in a scale, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. The first two metrics that we're going to look at are the EBIT growth and the margin growth. The EBIT has gone down, going from $30.7 billion in 2013 to almost $23 billion in 2022. The average growth in margin, however, still was 3.2%, meaning no change in our margin of safety. Margin has also gone down, going from 23.8% in 2013 to almost 19% in 2022. The margin has gone down with a 3% average, meaning a 5% margin of safety increase. The next two metrics are the dividend growth and the payout ratio. Dividends have gone up, going from $1.72 a share annually in 2011 to $2.08 a share annually in 2021, making a big dump in 2022 because of the acquisition, or the spin-off rather, of Warner Media. The dividend growth average annually is minus 2.5%, but I've chosen to not include it because of the spin-off, because that wouldn't be fair. The payout ratio is sitting at a very solid 50.1% payout ratio, meaning no change in the margin of safety once again. The final two ratios are the debt to EBITDA and the return on invested capital. To get a debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For AT&T, this is 437% debt to EBITDA, which is incredibly high, meaning a 5% increase in the margin of safety. The return on invested capital is sitting at 11.4%, meaning no change in the margin of safety. Looking not that great so far for AT&T on the metrics. Let's see if they can regain themselves in the valuation models that will determine the intrinsic value of AT&T. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2013 to 2022. The average growth in cash flow during this period was 6.42%, but we're going from an expected free cash flow growth of 10 years, and I've gone with 3%. This way we can determine the future free cash flow of AT&T and determine the terminal year valuation using a perpetual growth rate of 3% or 2% rather, and a discount rate of 9%. The sum of free cash flow then is determined at $378.5 billion, and all that's left to do to get an equity value is add the cash and equivalents and subtract the debt. Doing this, we get an equity value of $199.7 billion, and to get a discounted cash flow price per share, we have to divide it by the amount of shares outstanding, which for AT&T is 7.1 billion shares. Of this then, we get a discounted cash flow price per share of $28.01, and with the current price of $19.86, we get an upside of $8.15, which is a 41% upside. The second model that we'll be using is the dividend discount model. In this model, I've imported the dividend payouts going from 4 years ago to the current year. The average growth rate in dividends during this period was minus 10.67%, but we can of course make an assumption on what the growth rate will be in the future. I've gone with 2.5%. We're gonna also use a discount rate of 9% once again in this model. Out of this model then, we get a discounted dividend model price per share of $17.50. And with the current price of $19.86, we got a downside here of $2.36, which is almost a 12% downside. The last model that we'll be using is the multiple valuation. In this model, we'll look at similar companies to AT&T, look at their stock price and their earnings per share. In this case, I've gone with Verizon as they are the only very close competitor to AT&T. This makes our average PE in the industry the PE ratio of Verizon, which is 8.02. All that's left to do to get our fair value here is multiply by the earnings per share that AT&T is generating, which is $2.42 a share. Out of this then, we get a fair value of $19.42, and with the current price of $19.86, we get a small downside of 44 cents, which is a... Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, and multiple valuation prices per share. Out of this, we get an average of $21.64. Not including our margin of safety, our upside would be almost 9%, but we have determined our margin of safety earlier by using a standard margin of safety of 25%, adding 5% for the debt to EBITDA, and adding 5% for the margin growth, leaving us with a margin of safety of 35%. Applying this margin of safety, we then get a fair value of $14.07, and with the current price of $19.86, we get a downside then 29.1%, so in that case it would be a sell. If there's any other dividend companies that you would like to see me cover on this channel, please let me know, and thanks for watching.